Hello and welcome to the 2022 Howard Bailey Financial Market Outlook webinar. My name is Casey Weade, and I'll introduce our other guests that we have here in just a moment. Prior to that, I want to give a few minutes to allow everyone to get in the room as some are maybe preparing that last cup of coffee before they jump on the call. In the meantime, while we're waiting on everyone to jump in the room, we have launched a poll for everyone. So there's a poll there on your screen. We just want to gauge market sentiment right now. What's your current market outlook? How are you feeling about the market today? You feeling optimistic? Are you feeling pessimistic, neutral? We'd love to get a little gauge as we start the conversation here on where our audience stands as a whole. Today, as we're allowing everyone to jump in on the call, we've got Bill. Hey, Bill, how you doing? Bob, Bruce, Justin, Kathy, Ken. We've got people joining us from all over the country today, and we're really excited to go through this conversation. It's something we've been building up to for quite some time. So I'm Casey Weade. If you didn't know, I'm the president here at Howard Bailey Financial, certified financial planner practitioner. We also have Marshal Johnson. Marshal, give us a little hey. You might recognize that from the radio show or the podcast. Marshall is our vice president here at Howard Bailey Financial, one of my closest friends, and he has been with us from the beginning. He's also a certified financial planner practitioner. Then we have Timothy Sargent joining us today, also known as Sarge by his friends and family. Sarge is one of our partners. He's actually joining us from Sterling Capital. Sterling is one of our partners. I'll let Tim expand on here in a moment. But essentially, here at Howard Bailey Financial, we believe that we're always looking for the best tool for the job. And you know that if you've worked with our team, if you've worked through our framework, our planning process, you know that we're looking for the best tool for liquidity, best tool for income, best tool for growth, best tool for long-term care or tax-free income or death benefit or legacy. We're always looking for the closest distance between 2 points to maximize efficiency. And we do the same thing in the structure of our business. We believe a certified financial planner's job is to do financial planning and play the quarterback role in that financial plan, working directly with you to optimize all those aspects of your financial life. One of those being your investment strategy, and specifically the individual holdings and allocations that we might have from should we hold Ford or should we buy Tesla, et cetera, and what kind of moves do we want to make over the short term? Well, we partner up with the best in the industry for that. We partnered up several years ago with Sterling Capital, and Tim acts as our outsourced chief investment officer. So Tim is our chief investment officer, and he brings with him a wealth of experience and knowledge. I'll let him share with you a little bit more about that in just a little bit as I hand the mic over to Tim. But he is one of our key strategic partners here, making sure that when it comes to managing your individual investments, that someone's monitoring that portfolio every single day with your unique goals and purpose in mind. I believe we want to find a team of individuals to do that live and breathe it every day, while Marshall and myself and the rest of our team are meeting with and assisting the families we work with day in and day out and paying attention to that big picture. With that, I also see some questions coming in already. I'd love to see that. If you have any questions, this is how we'd love to have you submit them. On that Zoom screen, there is a Q&A button in the bottom right-hand corner of that screen. Just click on the Q&A button, drop your questions in there, and we will be answering those throughout our conversation. So again, drop your questions in Q&A. We'd love to see as many of those questions come through as possible. That's what we're here for, is provide value to you. So whatever you would get the most value out of in this conversation, make sure that we hear that. At the end of this conversation, we will have the ability for you to schedule time to meet with our team. If you are joining us and you are an existing client of Howard Bailey, you'll just scroll to the bottom of that link. So go to the link, go to the webpage, scroll to the bottom, and click on the name of your primary advisor relationship, and you'll go directly to their calendar. If you are not currently working with Howard Bailey and you would like to set up a time to discuss how what we're going to discuss today ultimately impacts your plan and what we would potentially adjust in order to adjust to the current economic environment we find ourselves in and so much more, then you can, again, click on that link, and at the top, there's a place that you can schedule directly to our calendar. So again, link is in the chat, and don't forget to drop that Q&A in. With that, I'm going to hand the mic over to Tim.
Casey, thank you so very much. I appreciate you giving me some time today. Marshall, you as well. And then certainly everyone else who is on this particular Zoom meeting, thank you very much for your time today. We're going to try to make it entertaining, try to make it impactful, and also interactive. Again, I'm going to echo what Casey said. We certainly encourage questions. If you think it's terrible listening to me without any kind of interruption or questions, trust me, it's actually worse for me. Nothing worse than crickets. So we do encourage some participation. Just quickly, some introductions, titles, and so forth. I am Tim Sargent. I am a director and client strategist for Sterling Capital. I have been in the industry since 1997, so I guess that's 25 years. So I have earned the gray hair on the beard, the male pattern baldness that no one can see. Certainly with the ups and downs of what we have seen with the markets up, but then certainly some of the challenges in 98, 2000, 2008, 2020, and so forth. So lived and breathed the good and the bad times. I went to school up in Ohio. So even though I live in the great state of North Carolina now, and I always like to joke with my friends up north still, I never have to shovel sunshine, again, have the hometown roots in Ohio. In fact, where I went to high school from Fort Wayne, all you have to do is jump on 30 and basically drive for about an hour, hour and a half, and it gets a little Bluffton, Ohio, which is real close to 75. And that is where my wife grew up. That is where I went to high school. And for better or worse, wherever we went to high school seems to be home, even if it means I graduated with 74 people in my small little class. I've got two beautiful daughters. They are the pride of my life. One is a junior in college. One is a junior in high school, which again, good grief. I guess time flies by. I guess if you take one thing from this conversation today, when you have kids, when you see them today, give them a hug because they will grow up in a hurry. Also, again, live in the great state of North Carolina, but I'm not going to forget my roots. My mom and my brother still live in Cincinnati. So if there are any Cincinnati Bengal fans like myself on the call, a little Who Day, very excited for the season we just had, and certainly are hoping for a great game and an amazing victory come this Sunday. So with that, I'm going to stop sharing and see if there are any questions regarding the economy before I talk about how we feel that's going to affect the stock and the bond market.
Well, we do have a question from Joe Licari that I think would be in line with this. Joe says, with inflation and the Fed raising interest rates, seems there's no good place to invest. Bonds aren't good in a rising rate environment, and stocks PE gets adjusted down. So stock PE gets adjusted down. Real estate has been growing, but may get crushed as interest rates go up. Should we move the bulk of our investments to cash and suck up the loss in value due to inflation for the next year?
Yeah, that's a great question. And candidly, that was actually well written. So well done. I really appreciate the question. So that really dovetails nicely into let's talk about how we're positioning in the market and all that stuff. So I'm going to kind of roundabout way answer that question, if that's okay. Make sure I answer at the end. So how are we currently positioned? What do we think, and so forth? So with regard to how we are currently positioned, we came into the year and in January, early January, looked around and said, we think bonds are going to do better than stocks over the next 12 months. So we actually put an overweight to bonds and an underweight to stocks. And that was not because we thought bonds were going to have a great year. Certainly, like the gentleman asked, in a rising rate environment, isn't that bad for bonds? The interest, yes, right? So it's kind of a teeter-totter. When interest rates go up, the value of a bond goes down, and vice versa. So right now, the market's essentially priced in for interest rate hikes that the Fed is going to implement this year. So we have seen a down year in bonds so far in January, early February, but bonds have significantly outperformed equities or stocks. So that trade worked out well for our clients. Going forward, how are we positioned? We do like domestic stocks more than we like international companies at this point. We like value companies more than we like growth companies right now. And what does all that mean? All right, so a value company is a company that pays a dividend, and some sectors could be energy, could be financials, things of that nature, right? So for example, banks would be a traditional value type sector. And a way banks make a lot of money is through something called net interest income. What's that? Well, we know what banks do, right? They basically give you zero money for your money market CDs and so forth, but then they charge you a lot more for your mortgage, right? And the steeper that slope, the more juice is in that orange, and they make more net interest income. So as you saw when I had the slides up with regard to the yield curve, it had steepened dramatically. So there's more juice there, and that's one of the reasons why dividend payers and value type companies have done better so far this year. Also, growth companies, not to get too nerdy, but really value them with the present value of future cash flows. You have to discount it with a number. If you have a higher interest rate, that number makes that future value worth a little bit less, like the gentleman typed. So we think that there was going to be some volatility in the market. Certainly we have seen it. We've seen the market kind of recover here a little bit, kind of a relief rally. It would not surprise us to still see continued volatility, at least for the first half of the year. And when people say volatility, they never say volatility on the way up, right? The market's going up, everyone's happy. They only care about volatility on the way down, or when there's maybe a correction, which is the market being down 10%, or a bear market where it's down 20%. We have seen correction territory in some of the indices, the NASDAQ, I believe, small caps as well. The S&P might have been close to it, maybe intraday, but kind of bounced back a little bit. So we were positioned appropriately to avoid some of that mess. But on a go forward basis, right now, again, first half of the year is going to be some volatility. Second half of the year, we think can do better. We think value stocks are going to do better this year. We think growth stocks will probably do better heading into maybe fourth quarter and then beginning of 23 through 24. With regard to trying to time the market, that's just really challenging to do. Again, we have more than 50 CFAs that work with us, and we get the general direction generally right on where the market's heading. For anyone to say they know when it's at the top or when it's at the bottom, I always say that if that happens, one of two things is happening, right? Either the person telling you that is lying to you or lying to themselves. Now, I don't know which one's worse. So if I ever come out and say, hey, I can tell you when the market's going to go up or down, whatever you do, just click this off, or if we're in person, grab your wall, grab your purse, and sprint out of the room because it's disingenuous. I would say working with the professionals at Howard Bailey, again, you have Casey, Marshall, and there's several others on the team as well, who can really work with you to make sure that you have that plan in place so that you are taking the amount of risk that you can take to optimize your returns, and then also have that discipline when things get a little bit challenging, because market volatility is the price you pay for returns, right? I mean, at the end of the day, if you want something that has less volatility or even a set interest rate or with maturity dates and so forth, you're giving up liquidity and you're not taking risk, which then means your returns are down. The compensation you get for volatility are historically higher returns. We think it's going to be choppy, but I would stick to the plan that your investment professional has put forth if that investment professional works at Howard Bailey. If not, maybe click on that link and have a conversation with somebody there.
Now, I'd like to add a couple things to that, maybe a little color and also my own anecdotes. One, let's just take a look back. If we always did what we felt the market was going to do and what we saw in headlines, we'd probably be wrong, a good majority of the time, especially over the last decade or so. I think we can point to 2020. Marshall and I are actually going to do a podcast later today, well, shortly after this, on fear and greed, and those being the worst enemies of the investor. And if we look back at 2020, all signs would have pointed to move everything to cash. If we went back to 2020, stock prices were surging in the spring, and then the summer of 2020 continued to rise despite double-digit unemployment numbers and closures of entire economic segments altogether. And so all signs, all economic indicators said, move to cash. However, had you moved to cash last year, you would have lost the opportunity to continue to expand your portfolio and create more gains till the point of today, where you would have much more today than you would have had a year ago. And that would have allowed you to even control that risk even more moving forward. I also want to say, I would never move everything that I have to cash, and I never have. I think, Tim, you're never going to move everything you have to cash. Marshall's never moving everything to cash. And I also want to speak to kind of another question we had around some of those names that Sterling manages funds for. You saw Parkview Health, on that list, being the largest medical provider here in Fort Wayne, and then many others on that list. What would happen? I'm just curious for my own, information, Tim. What would happen with those relationships if you moved everything to cash? How would those boards react, and why might you not do that?
When you're talking about institutional clients, you have something called investment policy statement, and you must adhere to it. So if you violate that, you're going to find yourself without a client. That is what's going to happen. Now, certainly you can have discussions with your clients saying, hey, we think that, let's say it's, for example, let's just talk about, like you said, April of 2020. We actually, in April of 2020, we're having discussions, and what we did was we went overweight stocks versus bonds, right when, again, the headlines would have said do differently, and people's emotions absolutely said do differently. And that worked out for our clients. We'll have those discussions with them to encourage them. Hey, maybe you want to take on some more risk, even on the fixed income side of things. We added TIPS, which are Treasury inflation protected securities. We added some high yields, good spreads have blown out, widened out dramatically. And those trades worked out as well. So we certainly have conversations with them, maybe encourage them to sometimes take a little more risk or take a little less risk given the constraints of the IPS. But if we were to go straight into cash, you're going to find yourself without clients in a quick hurry.
I was going to, Casey, if you don't mind, I was going to speak a little bit to volatility. And this is something that investors haven't had to deal with outside of March, possibly of 2020. They haven't had to deal with a whole lot of volatility, especially like we've seen in January. If you look back on January 20th, intraday, the NASDAQ was up over 2%. And before the end of the day, it surrendered all of those gains, 2% move. But then you have the reverse just a few days later, January 24th. The S&P was down as much as 4% during the day and was able to erase all of those losses. That's just intraday volatility. And that's something that investors haven't really seen or had to deal with. But a mentor of mine always taught me that volatility in volatile markets put a spotlight on discipline. And you're hearing Tim talk about value strategies and how they may come into favor. Well, value strategies greatly lagged growth strategies for the last couple of years. That's why we preach diversification. We want to own both growth. We want to own value. We can overweight one to the other, but these are conversations where diversification is key in trying to remove those emotions, really having a disciplined approach. That's what an investment policy statement's all about. That's what the big boys want, is a statement that defines their relationship.
Yeah, and ultimately at Howard Bailey, we want to put together a plan that makes that question null and void, right? We don't need to go to cash because it doesn't matter what happens in the market over the next 12 months, 5 years, and in jeopardizing your plan. We've put together a plan that no matter what happens in the short term, you're going to be okay. If you're asking questions like, well, I feel like I should go to cash, then that tells me maybe we don't have the right plan. Maybe the right plan isn't in place to give you the peace of mind you need to have to stick the course during volatile times like we're inevitably going to experience. And this may be a very volatile year, but if you have a good financial plan, then you shouldn't be concerned with these short-term swings in the markets. And that's what our framework is designed around. Tim, we have a couple questions around bonds. I don't know if you want to go into that right now or if
let's do some questions. Let's give the people what they want.
All right,
More cowbell. I'm sorry.
We have a few questions around bonds. Nancy has a question. She stated, what about savings bonds? So she'd like a little insight into savings bonds. Now, I think you might be able to tie these together. John submitted a question saying, with respect to bonds, are you recommending high yield instruments? So I think let's dive a little bit deeper into our assessment of the bond market, specifically savings bonds and high yield.
Yeah, so even though they both say bond at the end, they could almost not be more different, right? So if you're talking about a savings bond, you're kind of like talking like, what is it, the double E bonds, where you buy it at $50 and then at some point in the future, it's worth $100. You go to the bank and you get your money and so forth. That would be the type of bond that historically, back when I was in college, I actually worked at a bank. So we did those. That would be something that my grandmother might have given me. So those, again, generally speaking, just hold them to maturity. So what happens between now and then is almost immaterial because you don't get an income stream from that type of bond. It's called a zero coupon bond, right? You buy it at 50, you get 100. It's just how many years it takes to get there determines what that particular underlying interest rate is. So again, interest rates are going to be very immaterial to what's going on with that as long as you hold to maturity. When you're talking about high yield, that's just completely different, right? So our industry is really good at using words to market. And what do I mean by that? So Michael Milken back in the 80s got in a lot of trouble for junk bonds. Well, we decided
nobody wants junk, Tim.
Yeah, it's really hard to sell junk. Know what it's easy to sell? It's easy to sell high yield.
There you go.
And they are the exact same thing. We literally just changed the name. So there are times when we like high yield bonds. Again, I highlighted one earlier. April of 20 is we actually put high yield out of benchmark allocation into our portfolios. And again, that worked out well. Right now, our outlook on high yield is not overly positive at this point. There's a couple of different reasons for that. First of all, high yield bonds have a higher correlation with stock markets than they actually do a traditional like treasury bond or corporate bond that really matter more what's going on with interest rates in the Fed. And also spreads have compressed, right? So I'm going to get super nerdy, really sorry. But a spread is the difference between a government bond and a corporate bond that mature at the same day, right? And they can be big, they can be small, and they move intraday. And so if you have a spread and it compresses, you make money relative to a treasury. If you have a spread and it widens, you lose money relative to a treasury, right? So a bigger spread is like interest rates going up, it's negative. A compressing spread is like interest rates going down, it's a positive. Well, right now, high yield spreads are really tight, really tight. So we are at this point underweight high yields and don't have the most positive outlook given how compressed spreads are, and also the fact that equities we think are going to have some volatility and interest rates we think are going to go up several times this year. Great question.
Yeah, in general, Tim, what we see is along the lines of what you say. I feel that a lot of the financial advisors that are managing portfolios, a lot of the money managers out there, they are, as we've been saying for years, they've been reaching for yield. And Marshall and I have spoken to this quite a bit over the last couple of years, meaning that they go, whoa, Bond market scares me because if interest rates go up, bond prices go down. And even if they don't go up, I'm only making 1-2%, in a high quality bond. And so we're seeing investors, financial planners, portfolio managers going, okay, I guess it's either cash or stocks. Now at Howard Bailey, we see that a little differently. We're looking at it on a broader perspective. We're not just looking at securities. We're going, hey, if we have an aggressive client, by all means, hey, let's go heavier into the equities. However, most of the families we work with, they're in a pre-retirement category, and they're more concerned with capital preservation than they've ever been before. They don't want us reaching for yield, and we don't want to do that either for them. So, but they still need yield. They still need some type of conservative allocation in that overall portfolio. For us, we believe that that is a good fit for a bond alternative, say a fixed annuity or a fixed indexed annuity. A fixed annuity today, if we look at the aggregate bond market, I'm looking at AGG right now. So if we look at AGG, the aggregate bond market's yielding about 1.9%. High yield is yielding about 4%. If we go get a fixed annuity for 5 years, we're going to get around 3% without the risk to our principal, without the risk of default, without the risk of interest rates going up, and the value of that holding going down. So if we're going to look for a bond alternative, if we want to make in that 2 to 6% range, then we might be better off looking away from the bond market altogether. Now, we work with families all over the country that have different preferences. That's not always the right fit for everybody that we work with. However, as far as bond alternatives go, if we're looking for a conservative solution, investors are really in between a rock and a hard place. There aren't a lot of great high yield options in this interest rate environment. So we may have to look outside of that traditional box.
Yeah, and I think that's one of the great reasons to, again, to work with you. It's if all you have is a hammer, everything looks like a nail. If you have a variety of investment solutions, then you can provide the right solution for each bucket that a family needs to achieve to get to and through their investment goals.
Yeah. And for some reason, Mark asked a question. He said, your thoughts on bonds compared to indexed annuities? I guess that was asked 3 minutes ago. I think I answered it, Mark. I don't know, Marshall, if you would have colored that a little bit.
No, I thought that's where you were going because you saw Mark's question.
I didn't even see the question.
Yeah, no, that's a good question. I think a lot of people today are starting to weigh the difference there in their allocations. And, Roger Ibbotson did a great white paper on starting to utilize specifically fixed indexed annuities as bond alternatives. And it's not a one versus the other. I mean, he did some studies that showed the traditional 60-40 portfolio, 60% equities, 40% bonds, and then splitting the allocation of bonds, 20% bonds, 20% fixed annuities. But I think it helps to understand that when you're purchasing fixed annuities, what is the insurance company doing with your principal? They are buying bonds. And so you're leveraging the purchasing power of a Great American or a Pacific Life or some very large insurance company that's purchasing bonds in much larger quantities than you or I, so they can get better yield. So I think it's a relative question, and as you mentioned, Tim, it is just about tools in the toolbox. Going to be perfect for some, going to be a challenge for others. But this piggybacks on Harold's question here, who says, "Why are CDs so obsolete or scarce?" Tim, this kind of goes back to your point about banks and the net interest, how they make money when they have to write 30-year mortgages at 2.5%, there's not a whole lot of juice there to offer CD rates that are attractive. Maybe if the Fed raises interest rates for a couple more years, we might start to see those CD rates come up, but those banks are not real happy about how little they've been making on the other side of that business.
Yeah, and to dovetail on that, we think that those rates are going to be sticky for a while, right? And what I mean by that is banks are pretty quick to cut rates when interest rates go down. Yep. They tend to lag a little bit when rates go up to raise rates. And Marshall hit the nail on the head. And we do think that because they haven't been as profitable as they'd like during this low interest rate environment, we think that those low CD rates are going to be sticky for a longer period of time than maybe you would think.
We have a question that does refer to interest rates from M. And so I'm going to, let's answer M's question. It's Marty or Michael, but let's answer M's question. It is, even though the Fed is raising rates, this really alludes back to your original V-shaped recovery talk about 2020 and kind of what we've experienced here year to date. So even though the Fed is raising rates, why should or shouldn't we expect a V-shaped recovery from the current downturn in many stocks since January 1st?
So with regard to interest rates, right? So when the Fed is raising rates, they are doing so to battle inflation, right? They are, and what they're trying to do is they are trying to lower the growth rate of the economy. That's what they are going to do with raising interest rates. And the Fed's pretty good at getting what they want. Now, they're also pretty good about overshooting a little bit, right? So sometimes when they want to slow the economy, they'll throw us into recession. And when they want to get us the economy going, then they give us inflation. But there is a saying called "Don't fight the Fed," and even they are going to raise rates. That is going to slow the economy down a little bit. But even more important, we've all heard about quantitative easing. Maybe quantitative easing is when the Fed takes on a lot of bonds onto its balance sheet. This most recent cycle, they were showing at the peak $120 billion worth of bonds, or excuse me, not bonds, $120 billion worth of dollars into basically the economy of the market every single month. And $120 billion a month turns into real money after a while. And there is actually a 97% correlation between central banks' balance sheets and the stock market since June of 2009 through 2022, the first month of the year, this year. So yes, stocks can go up, and frankly, historically, stocks have gone up as the Fed starts to raise rates. Something to keep an eye on is when they start unwinding the balance sheet and so forth. We still think that, again, stocks are a great place to be for a portion of your assets. Historically, returns are better than others. And even though we're talking about interest rates going up, even if they raise 4 times this year, we're still talking about 1%, which is still historically exceptionally low. Some of you on the call might remember back in the late 70s, early 80s, when interest rates were just so much higher. So if the alternative is stocks and bonds, stocks still look pretty attractive for a lot of investors. But again, that's why you want to work with the Howard Bailey, because they have more than just those 2 solutions with which to work.
And Nancy was referring back to an email that we had sent out last year, just notifying all the families that work with us that Series I savings bonds were at an incredible offering at that time, at about 7%. However,
that doesn't stink, by the way. That's I'll take 7% all day long.
Boy, if we could allocate more than $10,000 a year there, then we would definitely would have leveraged those a little bit more if we could have. David had a question that was directly at the national debt. David said, what are your thoughts about the national debt surpassing $30 trillion with interest rates going higher? What impact will that have on the markets?
That's a big question, right? That's the question. I get that all the time. I literally had a conversation with one of the portfolio managers about that topic yesterday. So maybe I should pull up my notes a little bit. But essentially, there is a balancing act, right? So even though we have $30 trillion, which again sounds like a lot of money because it is a lot of money, we are paying exceptionally low interest rates on them compared to history. So the question is, okay, if we're paying so little now, what happens if interest rates, what's the 10-year treasury, 1.8-ish? What if that doubles, right? So what if we're paying like 3.6 or something like that? Isn't then that the interest that we're paying significantly higher? So the answer is yes, right? So what the government and the Fed want is they want to grow the economy, so have inflation higher than the interest rate that they're paying on the debt. right? So if you're paying whatever, we'll call it 2% or 3%, we'll call it 3% on your debt in a couple of years, and that's just for discussion's sake. I'm not saying that's going to happen. The Fed's going to want to have an inflation rate somewhere higher to that, and then also they want and the reason is GDP then grows, and the bigger the economy, the more tax receipts then that they take in to be able to cover it. It is something that we watch exceptionally closely, and it is something that, as a father, has all my attention for my two lovely and talented daughters. And I'm sure everyone here has children and grandchildren that they care deeply about. But that it is concerning that we, on either side, really just don't have any fiscal restrictions, right? I mean, if you like the current president, you probably didn't like the last one, and if you like the last one, you probably don't like the current one. But it seemed to me like both of them were just shoveling money at the problem, trillions at a time. And I do remember when $1 trillion used to be something, and that's the old joke, right? Don't tell a politician in DC what comes after $1 trillion, because they'll try to spend it. But certainly they want to try to thread that needle of having inflation and tax receipts grow faster than the national debt.
Right. That was a really great answer. I did drop a link to that Roger Ibbotson white paper that Marshall mentioned earlier into the chat. So if you'd like to get that, go ahead and check out the link there. We also had a question from Bill pertaining specifically to Howard Bailey Financial, saying, do you have financial advisors who are fiduciaries? We are a registered investment advisory firm. We're not brokers. All of our advisors are investment advisor representatives of Howard Bailey Securities, a registered investment advisor. Just like Sterling, we are fiduciaries because we adhere to the Investment Advisory Act of 1940 versus the vast majority of financial advisors which fall under broker law, and they are brokers that have a suitability standard rather than a fiduciary standard. So I thought I'd knock that one out real quick and get back to the market. We have a question that came in early from Tug. We also, I'm going to tie this into another question that we had from Antoine that was submitted prior to the launch of the webinar. So Tug and Antoine, their questions tying together. Antoine said, should I move my portfolio towards gold and silver to hedge against inflation? And Tug's was, should we buy gold or silver?
Yeah. So first of all, I think that that's something that you need to talk to your financial planner and expert with. So your investment professional at Howard Bailey, I think you should have a discussion around that. Within the portfolios at Sterling Capital specifically, generally speaking, we tend to shy away from commodities or precious metals. It's not to say it's not something good to have a portion of your assets in, but generally speaking, the reason that you would buy precious metals is because you feel that someone is going to be more fearful of the market or the economy in the future than you are today. And the reason I say that is we like to buy high quality companies on the equity side that either provide a service or provide a widget and have earnings growth and profitability that they can sell, and then maybe they have a dividend and then share to the shareholders and so forth. Whereas gold, I mean, Warren Buffett, I think, said it best, where all you do is basically you pull it out of the ground, you put it in a fort, and then you surround the fort with guards, and that's it. It doesn't generate an income. It doesn't generate.
I believe it was all of the gold in the entire world, if mine could fit into 2 Olympic-sized swimming pools, right?
Yeah,
or he could
like
own all of the farmland in the U.S. plus several Exxon
like
Mobils.
15 Exxon Mobils or something.
Yeah, which one would you rather have?
Yeah. So again, it's if you want to have some, fine, but it's not something we have heavily in our portfolios for those reasons.
Well, and I think too, I would speak to the fact that Antoine had asked this question specifically, is it a good hedge against inflation? And historically, the answer is no. It's maybe in the top 10 as far as a hedge against inflation, but stocks, just a pure 60-40 stock bond portfolio, have traditionally real estate income producing real estate tips. Those have all been far better at hedging inflation. And to your point there, Tim, stocks, inflation generally can be a good thing for an equity-based portfolio. So as you alluded to, gold and silver, those are more of a crisis. Gold specifically is more of a crisis hedge. And sure, if you want to own 5% of your investable net worth in a crisis hedge, that's okay. But I wouldn't overweight the boat.
Yeah, you're going to see that exposure in many of the portfolios if you actually open up your statement from our custodian, Fidelity, and actually look at the holdings. There's a real high likelihood you're going to see some exposure to precious metals in there. And if you would like to have a little assistance in us, breaking that open and showing you exactly what your exposure is, we'd love to do that with you. Again, we dropped a meeting link in the chat. We're going to do that again here in a little bit, and you can always check in with your advisor that way. I would also, we've got a question about taxes, and we did receive a couple of different questions around taxes. And I think this is a short-term and a midterm question, right? And in a long-term question, you could also argue, right? So we can look at today some of the proposals that we've seen and that have also been shot down over the last 6 months. And what we might expect from a tax perspective over the next 6 to 12 months. But then we also have the automatic tax raises that are going into effect in 2026. And then we have the risk of taxes going up in the future. I think it'd be interesting to just speak to this, Tim, from the perspective of, how do we think about taxes increasing in the future and ultimately the impact that that'll have on the markets. And if you have some insights that we can also provide for a tax perspective on 2022, I think that'd be really valuable.
Sure. So with regard to taxes, we just point to when the tax rate went down. So tax rate went down, stock market went up pretty quickly, pretty dramatically. And so you would anticipate if those taxes then were to go back to what they were before, you would see a comparable drawdown. And the reason for that is when you have, again, if a stock is, the value of a stock is the present value of its future cash flows, well, the more tax you pay on those future cash flows, the less valuable that present value is. So that would hurt just I guess we'll call it one of the ways you discount the value of a company. And then also higher taxes tend to slow the economy and so forth as well. And a slower economy tends to slow down equity growth and so forth. So generally speaking, higher taxes mean a worse market, and lower taxes, generally speaking, mean a higher market. Now, we'll see what ends up happening. If nothing happens, like you said, we're going to see the tax rates revert here in a few years to what they were, and we'll end up seeing what happens. I don't want to get political, but it seems like we're going to have a midterm election here relatively soon. And what I can say is whether the people on the Zoom like this or don't like this, the market loves Washington, D.C. gridlock, loves it. So historically, when you have gridlock, meaning you have a president and you have Congress that don't want the same policies, the market tends to do better. When you have presidents and Congress that get everything they want, markets tend not to do as well. So if what happens this election cycle is what happens typically, which is the party out of presidential power tends to win in that first midterm, that would provide gridlock, and that would be good for keeping taxes where they are probably, and then also good for the market as a whole.
So I would speak to that, and I'm always thinking of good quotes. Casey knows that, but John Wooden famously said, flexibility is key to stability. And I think we've talked a lot about the markets today. We've talked a lot about different changing interest rate environments. We've talked about higher tax rate environments. You have to stay flexible. And one thing that you can do, if there is volatility and you have losses in your IRAs, talk to your advisor about converting assets out of IRAs to Roth accounts. Try to diversify not just your portfolio, but diversify your tax buckets. So if you are concerned about higher taxes in the future, make sure you've got other types of tax buckets that you can withdraw from. Take advantage of the volatility, take advantage of the low interest rates. Try to remain flexible so you can remain stable.
And that was a lot of what we did in March of 2020 and there for a couple months when we were just talking over and over about the importance of Roth conversions. And I myself, Marshall, we converted all of our IRAs to Roth during that period of time, paid the taxes and watched it rebound, paid it on a depressed asset, and we're able to watch those assets rebound. And I think the beauty of being with a firm such as ours is we're sharing with you exactly what we're doing with our own assets, with our own finances, and making those same recommendations back towards you. We may have time for one more question. And this one, we hit on this, Tim, right before we got started. This was about Ukraine. So this was one that was submitted by Jim prior to the start of the event. Jim said, should I be concerned about a bear market on the near horizon between Fed policy and Ukraine tensions? So I really want to specifically focus on the Ukraine tensions because I think we've spoken to Fed policy, but between Fed policy and Ukraine tension, I fear there's more tumultuous market activity on the way. So should I be concerned about a bear market on the near horizon? So let's just kind of talk about that.
All right, so let's see if we can do this in 2.5 minutes. So no, so we think there's going to be volatility, but a bear market's down 20%, and we're down what, 5, 6-ish. I don't know what's going on intraday right now since we've been on this call. So that would be a significant drawdown from here. So we think there's going to be volatility. Could happen, but that's not our base case. With regard to Ukraine, that would be something like we just talked about. Like that could potentially be kind of a buy the dip kind of a situation. And what I mean by that is, even though it would potentially be tragic for the people of Ukraine, and anytime there's a conflict, there's a loss of life, and that would be horrible. And I don't want anyone to die unnecessarily. And that would be tragic. To sound callous, economically it doesn't matter. Ukraine is as important to global GDP, which is gross domestic product, is essentially like Rhode Island. Like it's just, I mean, it's a bit of an exaggeration, but not much. It's just not that important economically. So even though it would be tragic for humanity, sure, it would not be tragic for your long-term growth of your portfolio. And there probably would be volatility, right? Because market doesn't like war, but that would be more potentially the buy the dip type of a situation because of the impact of Ukraine on the global economy scale.
Thanks, Tim.
Yeah,
well,
I was going to say, Harold's got a great question there at the end, but I know we might be out of time. But don't wait, Harold. Start taking withdrawals. We can talk in greater detail if you want to get into that, but don't wait for those mandatory withdrawals.
Yep, we have about a half dozen questions that we didn't get to, but we will get you answers. So if we have your name here, we'll be getting answers directly back to you. I went ahead and copied and pasted them onto a Word document just in case I lost those Q&As. So with that, I want to wrap up with, again, we shared with you that meeting link. And once you click on that link, this is what you're going to see. You're going to see a landing page that we've created specifically for this event. If you go on down directly right here, if you're not currently working with Howard Bailey, this is where you can click to set up a time to discuss your situation and how what we've discussed today would apply, how that would apply to your unique situation. If you are currently working with one of the members of our team, you would have your lead advisor's name down here. All you have to do is click that link and that'll take you directly to their calendar so that you can set up a chat with them. Thank you all for joining us for the 2022 Market Outlook webinar. If you have any other questions, maybe come to you later, just shoot us an email at info@howardbailey.com, or you can go to retirewithpurpose.com. There's a little text box in the bottom right-hand corner of the screen. That'll text the question directly to us. We will answer any and all questions that you submit to us. Again, thank you so much for joining us. We truly appreciate it and respect your time.